A lot of people are putting a lot of blame on financial derivatives and these particularly complicated financial products for getting us into this mess. So the question is that fair? And also, could you explain what the social usefulness is of these financial contracts?
Well, rather than a yes or a no, let's start with how many. There's a misconception that these derivatives showed up with new losses. Not really. What they did is they moved the losses from one investor to another. Now, the financial engineers and the economists that have been touting these derivatives for many years have suggested that what's supposed to happen is the losses get moved to the investors that are best equipped to bear the losses. In other words, you spread the risk around the globe like peanut butter so that no particularly critical financial institution or investor gets hurt more than would be efficient. Well, in this particular financial crisis, it got turned absolutely upside down. Financial institutions that are supposedly very sophisticated and are critical to the functioning of the economy, like Citibank, like Merrill Lynch, like UBS, and AIG, those are the poster children of this financial crisis. They, instead of spreading that risk around with derivatives, they used the opportunity to use derivatives to concentrate the risks on their own balance sheets. And presumably they did that in order to make a profit. And ironically, of course, these most sophisticated financial institutions in the world they didn't know how to control their risk properly, and they took undue amounts of risks on a very narrow, undiversified class of risks, and they are right at the epicenter of the financial crisis. Of these derivatives, a lot has been made about how super complex they are. Well, there's two classes of them that have been front and center in this crisis. One is called a credit default swap, and that is dead simple. And the discussions in the press about these dreadfully complicated credit default swaps, that's wrong. These are just default insurance. If you don't pay me back on your debt and I have a credit derivative, I can turn it in as a chit and get made whole by the seller of protection. The other class of derivatives at the epicenter of the crisis are complicated. They're called collateralized debt obligations. And these are ones that repackage, slice and dice mortgage default losses, credit card default losses, commercial loan losses, and repackage them. These ones have been at the epicenter and have been partly responsible for creating the crisis because they seemed to encourage investors to do what was in a premise of John's remarks earlier. When the Fed lowered interest rates to the point at which investors were not getting very much return on treasuries, these collateralized debt obligations were touted as the next best thing, very safe, AAA rated, and they were offering higher yields than treasuries. And so everyone piled into those and encouraged more risk to be repackaged into them to feed the needs of these investors who wanted to buy AAA CDOs. And that encouraged house prices to go up because now people could borrow more to buy houses or buy bigger houses. The mortgage risks were getting repackaged. Everybody wanted to buy more of those CDOs. House prices went up further, and so on. This circle of price increases feeding a demand for supposedly safe securities was really up right at the core of the crisis. And these markets are going to have to be redesigned, and there's a huge amount of research and policy work going on right now across the world on redesigning, improving the infrastructure, and trying to figure out how the transfer of risk got turned upside down.
I'm going to ask the next question to Katie, but let me just set it up. We all get these statements from TI, Kraft, or Fidelity, or whoever it is, Vanguard, that tell us about our retirement assets, and basically it's been pretty painful news. Some people don't even open those envelopes these days. And similarly, the university looks at its endowment and sees what's happened. And the real question is, should people treat these reduced valuations as short-term aberrations, or should they say, I've lost a lot of money and I better reprogram my retirement, I better reprogram my the university's budget. That is, what's the right thing to do is to think, is it going to bounce back automatically, or should you take today's value as kind of a good starting point for basing your plans?
I think you have to start with a really harsh personal or organizational assessment about your time horizon of investment. And I think that many individual investors in their retirement plans and some institutions lost sight of that fundamental first principle. And as people got to a point in their careers that was later on where they actually really cared about the exact dollar amount they had, because that was underpinning a lifestyle that they wanted to continue with, they couldn't walk away from what seemed to be an endlessly winning game, and they didn't make the choices to readjust their allocation between boring, safe investments and things that had more upside. So I think as everybody is looking at their own personal statements, and as organizations are looking at it, you have to start with that first principle, which really is your own horizon. The shorter it is, the more certainty you need, the more you have to make an adjustment in your portfolio. I think, but conversely, one of the other issues is that in times of uncertainty, just because it's uncomfortable and painful, everybody wants to shorten their investment horizon because you feel safer. And if in fact you do have a sufficient horizon, 5 years, 10 years, or 15 or 20 or centuries, then you really do need to, I think, stick with your horizon, a longer term perspective, and, if you will, ride it out, because over the long period that you can invest, I think that with good management, with good investments in companies, you will be compensated for that.
So there, I'm going to opt for the centuries horizon. That sounds good.
Organizations have centuries.
Now,
well, it's a funny thing. I agree very much with Katie, but probably a lot of people, I certainly put me in this group, retrospective too much in equity, especially as you get you close to retirement, you're supposed to do more towards fixed income. Well, I didn't do that, but that's where it is right now. So, so no sense changing, right?
Well, and it's a question of overcompensating, because
right, you can overcompensate.
You can overcompensate too. I think that's the other.
Yeah, I think it actually could make sense. I mean, say you wanted to be 60% in equities, and you look at your latest statement and you're 30% in equities. So you might actually want to acquire some equities to get closer back to where your usual position is. Let me ask about lessons from history. History, of course, doesn't really repeat itself, but sometimes you can learn lessons from history. And so I was going to ask John Taylor to start off. Maybe somebody else wants to talk about it. I'm going to give him a multiple choice exam. The question is, which episode in history provides the most insight about our current situation? So the multiple choice exam, answer A is Japan in roughly 1990, when they had a huge real estate bubble and had the lost decade. Answer B is the U.S. savings and loan crisis, which actually went throughout the 1980s and culminated in the late 1980s. The third is, you got to put it there, the Great Depression. The fourth is, for those of you who have a long memory, the Panic of 1907. And you got to have answer E, which is none of the above, because this is a multiple choice question. What do you think, John?
There's the archives in Washington, there's a statue that says the past is prologue. One is the past is prologue, the other is remember the past. I don't think there's much past prologue here that's useful, quite frankly. So that means none of the above. It seems to me we have a financial crisis that's has its magnitude is like the Great Depression. It's completely different, it seems to me. That was a genuine liquidity problem. The Fed let money decline and just let that go on and on and on. Here, that's not what happened. Banks had problems then, but the problems here are basically based on a real estate boom and bust. So I think you really have to put together an explanation and a solution, which, if you like, combines different episodes in history. I don't think Japan, with respect to the deflation, is useful. I would say, to me, it's if you like, the closest thing at this point in terms of depth and severity is really the 1981-82 recession. You know, we're not that serious in terms of overall declines, but in terms of, there's a very interesting thing in 1980 that happened. Credit controls were put on trying to reduce the inflation rate, and there was a huge downturn in the economy, over 6%. Credit controls were removed and it just zapped back up again. And this is, of course, much different kinds of credit crunch, but that kind of thing can happen. So I'm looking for those experiences, John, and that's why I think that the crunch we had last fall, that panic that everyone, you know, felt so emotional, there is a sense in which that stopped and we moved, if you like, to a flatness. And I think the hope is that that flatness brings us into a more substantial recovery. And in many respects, I'm sort of worried about policy overreacting to that and then bringing back the fears of inflation I mentioned a few minutes ago.
So I think it's time for me to stop asking questions and for you to feel free to ask questions. And I'm inviting John Hennessy up here because we need some reinforcements to answer your questions. So I think now is your time, and we hadn't rehearsed, but I do see that there seem to be some microphones in the aisles, so if you could wait for the microphone to get to you and ask your questions.
And if you have a question either of me or of any of our panel members, we'd be happy to try to address it. If it's a question about the economy, they're going to answer it.
I have a question about going forward. Wasn't a contributor to this greed on the part of the people in power in financial institutions like banks and hedge funds and so on, who took risks because it was in their interest because they got big bonuses if they made money? Don't we need some kind of legislative or regulatory control that prevents human greed on the parts of small numbers of individuals from putting the economy up for the rest of us at this kind of risk?
Darrell's going to give it a shot. I might say something. Go ahead, Darrell.
Okay, so there is a certain human nature to reach for more whenever it's available. Yes, as an organization, the big financial banks were greedy. Now, what does that mean at the level of individuals? That meant that the risk management systems were not limiting that greediness and risk-taking. It meant that the compensation contracts, in some cases, encouraged the risk-taking because it paid you this year if you made a profit this year rather than waiting to see whether that was a real profit. But I tend not to make this a kind of personal thing about greed. I tend to think about it in terms of, again, contracts, risk management systems, educating management, particularly the boards and CEOs about what sorts of things are going on inside their banks. And if that's done well, then the organization won't behave as though it looks like a greed center, but rather that it's providing a service to the economy.
I agree with some of what the questioner said. I mean, the Wall Street bonuses in 2008 were the 6th highest ever. 2008 was not a good year in Wall Street. On the other hand, I think we could easily overreact. For instance, Senator Boxer has suggested that no banker should make more than the President of the United States. That may sound good, but it seems to me quite a bad idea.
My question is, how was it possible for these collateral debt obligations to be rated AAA? How is it possible to use some sort of an equation that says that these things are correlated when they're not possibly correlated? Can you just explain why that would be regarded as no risk?
Okay, so the simplest answer is they made a mistake. And one slightly simpler explanation is the fact that they didn't include in their analysis a scenario by which the housing market goes down 30%. Almost every risk management outfit, banks, hedge funds, Fannie Mae, Freddie Mac, and the rating agencies were putting their worst scenario for the housing market at either no price change or a 2 or 3 or 4 or 5% price decline as the worst case scenario. No one had it in mind that house prices would go down as they did. So basically it was a mistake based on relying on historical data rather than thinking about whether the economy was on a sustainable path.
So there was also the subprime mortgages, including adjustable rate. The foreclosure rates and delinquency rates on those were actually quite low in 2004 2004, 5, and 6 when these ratings were being done. Remarkably low, historically low. And I think that was because, in retrospect, certainly, you had this very high rate of increase in housing prices. So people had much more incentive to make their payments, keep up their payments. But as soon as prices started rising less rapidly and falling, they just walked away or didn't make the payments, and so the foreclosure rates went up. So in some sense, it's just the automatic underwriting formulas and equations that were used were misreading what looked like very good payments on a lot of mortgages.
You know, one other piece is that a lot of the CDO crisis was actually an unintended consequence to a regulatory regime that was imposed on the banks. There was the concept that it was important for the banks to have adequate capital. Makes sense. Developed a very complex system that says we're going to credit banks with a lot of capital for highly rated assets. So they created essentially an artificial demand for AAA assets. So surprise, surprise, an industry grew up that served up AAA assets for the banks to be able to do it. So it's a very interesting, and again, certainly unintended consequence to what was originally a regulatory regime.
I think a lot of these answers boil down to it's very hard to recognize a bubble during the inflating period. Now it looks like we had a housing bubble. It wasn't so clear in 2004 and 5 that we were in a housing bubble.
Okay, let's go over here.
My question also concerns the CDOs. And in particular, while it seems like the banks have gotten some relief through the change in the mark-to-market accounting rules, which I guess liberates some of their capital, at the same time, it doesn't seem like those bad assets have gone away or disappeared quietly in the night, but they sure have gotten quiet in the news. At the same time, it seems that the government's saying, we'll sell them to you for this, and investors are saying, well, we're willing to pay you this. So how is that all going to resolve?
Well, it's not going to be resolved by accounting rules that relabel the prices to a higher level than those assets could actually be sold for. It might be resolved if the banks are forced to sell the assets at whatever prices they can achieve. The government's method of doing that is essentially to subsidize investors to buy those assets from the banks, so that we can pry them away from the banks and not have them recognize such deep losses that they will be found to be insolvent. And that's basically the government's plan. It could be expensive. It might not work. It might work. We don't know yet.
Ed?
I'd like to hear from the other three panelists, that is other than John Taylor, on what the other three panelists think about inflation. The last words that are ringing in my ears is 10% a year for 10 years.
Well, I'll say, I don't know about 10% for 10 years, but I will say that in my personal asset allocation, I have a reasonably substantial position in TIPS, Treasury Inflation Protected Securities, which I think is really the best way to protect yourself if you fear inflation. Better than gold, better than whatever commodity strategy you can come up with. If you're just really worried about inflation, TIPS seem the way to go.
That's interesting, John. I have 100% of my pension, Stanford pension, in TIPS. And in the fall quarter, I taught a class on credit markets, and basically have been suggesting what John has just suggested, which is that although right now Treasury yields are very, very low because there's such a demand for safe assets, that once the need to fund the stimulus package and once the Federal Reserve's giant supply of money has to be released or absorbed by some other means, inflation rates are going to go up. I don't know about 10% for 10 years, but they're going to have to go up very substantially unless the Fed pulls a rabbit out of a hat in a way that I can't imagine.
I too am concerned about inflation very much, although I disagree with my colleagues that TIPS are the right way to actually solve the problem. I think it's actually quite an inefficient way to solve the problem, particularly in taxable buckets. But I think that people should look very closely at areas of investment that actually have a real store of value. I do think that takes you to hard assets, it takes you to things like timber, it takes you to oil and gas, it takes you to real estate, although real estate has to have some price clearing to take place. think it also takes you into dollar assets. I mean, we're really, one of the issues that we're all grappling with is, where will the rate shock, if you will, come from? Will the rate shock occur really through a currency consequence from the Chinese choosing to no longer finance us? Will it occur from sort of a demand pull? And it's unclear. And I think that you want to think about ways to build different kinds of protection into your portfolio, not just a single one.
We could have the doctor's rule of do no harm. Katie gave a good warning. Tips are not a particularly good investment in a taxable account. They're much better in a pension account.
Could we get the signal from you when this inflation period is about to begin, so we know?
It's like with everything, you got to go when it's not obvious.
Actually, so the 10% a year for 10 years, we don't have to do that if we do other things right. So, I mean, in 10 cents, it's a warning, and you're right to take it as a possibility, but my sense is if government gets its act together, we don't have to have that. If Fed gets its act together, it doesn't have to happen. So it's a warning.
Let's go back here on the right.
There seemed to be agreement that this downturn is not like others, and it seems to me that one of the most distinctive and unusual aspects is that we're now in truly a global economy where we can't just think about what is the Federal Reserve and the Treasury doing. We have to more broadly think about what is happening to other economies, because we need to produce and sell to other countries. We buy from other countries. So I would be interested in hearing the thoughts of some of the panel members, whoever thinks they're... Clearly you're going to speculate because we're so interconnected, but I would still be interested in hearing what you have to say about that. I'm not thinking about the next year or two, but some 5, 10.
So I'll just say one thing very quickly. I think you can't help but be optimistic long term about global economy. There's so much growth that's possible. You have, just to get to a standard of living like in the developed countries, the growth in the developing countries is going to be large for many years. So I have to say, unless we retrogress in terms of the overall philosophy, I think we've got to be optimistic about global economy over the long term.
Relative to a lot of commentators, I think I'm more optimistic about the economy as well. I mean, at this stage of the recession, people go, oh, it's going to last forever, and the recovery this time is going to be slow, and I don't think there's a lot of evidence of that. Now, the hole's pretty deep, so we can go pretty fast, and it's still going to take us 3 years to climb out. But I actually think we might have decent growth starting next year.
Okay, let's go over here.
This is a question for President Hennessy. You talked about the university's commitment to financial aid, especially for undergraduates. What about international students? As far as I know, it's been in the works to bring international need-blind admissions for over 10 years now. And international students contribute a lot to the university, especially in the technical disciplines, to Silicon Valley. And most of our peer institutions have it. So I have 2 questions. Why hasn't it happened yet? And given the current state of things, when will it happen?
Well, why hasn't it happened? It hasn't happened because we are a younger institution than some of our peers, supporting a university of comparable or larger size with an endowment that's typically smaller, let's say, than Harvard or Yale, for example, or we have a much larger university than Princeton, who has an endowment which is roughly the same size. So I think that probably says a lot about why we haven't been able to go need-blind for international students. There are also differences in the makeup of our international student body is rather different from that of our East Coast peers, and that also has affected the need for financial aid. When will it happen? My guess is it will not happen. I said 5 years ago that I'd hope to have it done within 10 years. I don't think we'll be able to do that. The size of the budget hole made for financial aid now will consume every dollar of the Stanford Fund and an additional $20 million that we don't currently have. So it's a $40 million, we have a $40 million shortfall essentially in the financial aid budget. So that is fixing that will be job one, and then we'll move forward to try to continue. Of course, we'll be trying to raise additional endowment for international students as we go along, but I think it's going to take a lot longer than we had earlier hoped. Any other questions back here?
Yeah, a question to the panel. Coming back to the AAA-rated CDOs and other securities, you may be being a little too kind to the rating agencies and the bank underwriting people who issued securities that they immediately passed on to other people, paid the rating agencies to rate them, paid the people who sold them commissions, paid the executives in the bank's big commission. There seem to have been systematic incentives that caused people who had conflicts of interest to systematically overrate these securities. They were issuing money to people that they didn't verify income, and so on. Is it really just an inability to predict that housing prices would go down, or were there some fundamental conflicts of interest in that system?
Darrell, being a brave man, said, I'll take that question.
Braver than you think, because I've just joined the board of Moody's Corporation, which is one of the top rating agencies.
It's all solved, no problems anymore.
So, conflicts of interest in ratings and underwriting. Well, speaking for the rating agencies, which are most accused of this conflict of interest, there is a conflict of interest. The rating agencies are actually, at least Moody's is very upfront about the fact that there's an inherent conflict of interest when someone is paying you to rate something that they're issuing. And none of the other models that have been proposed to avoid conflicts of interest have been found to have less conflict of interest or result in even reasonable ratings. In fact, the SEC had a meeting 2 weeks ago in which there was 4 panels, none of whom could come up with a scheme that seemed to have even a reasonable agreement would have less conflict of interest or produce reasonable ratings. One example would be a public utility model by which the government would simply collect money from all bond issuers, including collateralized debt obligation issuers, and then give it equally to all the rating agencies for rating those CDOs. And I don't know, we teach in economics that incentives matter, and that if you're going to get paid for something, no matter how well you do it, then the quality of the work might not be very good. Do I believe that those conflicts of interest are responsible for the AAA ratings that were mistakes? No. In answer to the question earlier, I think I'm pretty confident that they just blew it. They just had no idea that the whole structure of the housing market and the mortgage origination market had gone wrong, and they didn't include scenarios that allowed for that because they were over-reliant on past data. That's not to say they didn't make a mistake. They made a big mistake, but I don't think that the big mistake was due to a conflict of interest.
Let's see, do we have any further questions back here?
Yeah. So even though revenues are going down, it seems that innovation is continuing with the same speed. US companies are not cutting on that. And it's a pretty high rate of innovation now. And we see how people are getting more and more connected, and we're getting location-based services and whatnot, all new types of ways for people to agree on doing things for each other and building structures of trust. How does that sort of affect your projections? Do you think that growth is going to come back quicker? Do you think that we're going to have a new definition of growth in just a few years? I mean, will your definition stand? Or do you think we're just shortening the time constant in the communication between people, so we're heading for wild oscillations?
I think when John Taylor mentioned the advantage of globalization, I mean, one of the advantages, because of all the interconnectedness and the communications, is that countries that are behind in terms of technology can catch up faster. There aren't that many secrets in terms of technology. So I think that's one reason why you might think the global economy is pretty exciting, actually.
I agree with that.
Over here. One question that I wanted to ask, you really have had no mention of the global crisis in climate and its impact on the economy. So what is your thinking about the global economy in light of a crisis that really transcends even the last year of economic downturns?
Especially last fall, the financial crisis crunched seriously, globally as well as in the United States. That you saw just collapse of exports all over the world. A lot of it was the credit crunch came very rapidly, so it's definitely global. I think there's various explanations for that. Certainly some of the securities we're talking about now were purchased by foreign banks, a lot of them in Europe, of course, and the same excesses also occurred in certain countries. In Spain there was a housing boom, in Ireland there was a housing boom based on some of the same excesses that occurred here. So this is global, and you can explain some of the global aspects. And I think the rebound, if we have one, will also be global.
You know, from my point of view, one of the failures in Washington is to, in terms of environmental policy and climate change, is to face it head on. In other words, it's really hard to get people to conserve something that's cheap. And so oil was expensive a year ago, and we actually saw some conservation. But now oil is cheap, gas is cheap, and we don't see so much conservation. You know, there's a great deal of appeal to have a higher price of gasoline through a tax. We got plenty of need for the revenues, for heaven's sakes. And if we had prices as they do in Europe, we'd have a better environment.
I just want to mention one connection between the financial crisis and the environmental crisis that comes to mind, which is that as national governments have huge shortfalls in their revenues and are supporting their financial systems, they don't have the financial wherewithal to pursue the programs of environmental damage abatement that they had in mind. China, for example, has put on a shelf the plan that it had to replace a lot of coal-fired electricity generation because it wants to funnel the money that it was going to spend on that into lending to industrial corporations to help the economy grow. And I think we're going to see delays, unfortunately, in spending on environmental improvements. On the other hand, every time a crisis hits, as is said, it's an opportunity for change. And I think, for example, President Obama seems to be, at least based on the little evidence that we have so far, seems to be fairly committed to improving the environment. And one of the reasons he's there is that the financial crisis increased the impetus for a change.
Back here.
One thing that hasn't been mentioned, at least that I heard, was price to earnings ratios. And though I know those can be hard, particularly in growth areas, housing never seemed to me to be such a place, at least in average cities with average people working average jobs. Can you guys explain why price to earnings ratios don't seem to be driving these models of asset pricing?
That's for you, John Show.
Well, I don't really know what to say. I do think that house price, rental price ratios did get quite out of whack. And you also had these phenomenon where most people couldn't afford houses, which made no sense. In terms of the stock market, earnings are a little bit difficult to measure, but price earnings ratios right now are quite reasonable, below historic averages. And I also think there's quite a bit of room for earnings to rebound from the recessionary lows that they're in now. I'm not sure I completely interpreted your question right. Katie, maybe?
Maybe I think when you look at a lot of asset pricing, people have treated it as something that's more analogous to a fixed income instrument. So it has more of a yield type of vocabulary, or a cap rate is actually the kind of vocabulary they're talking about, which is what the yield of the cash flow generates. And so as rates were, one might argue, artificially kept low, yields that were demanded from those kinds of assets were also lower. And so the prices were up. And so that was one of the reasons why a lot of real estate assets in particular also went through this period of really dramatic price increases, because people extrapolated the consistency of the cash flow as essentially a bond yield that would stay forever, and they were comparing those yields. But I think it proved to be a failure.
Maybe I can improve my answer. There was this widespread view that's been mentioned that houses are safe assets, that their price never goes down. Now, if other safe assets are yielding 1%, and houses are really safe, you can justify any price for the house, or almost any price, if you really think houses are safe. And that was a widespread view. And so the shock is, houses aren't safe. And now they have to compete with risky yields, which are high.
Right.
There was some very serious commentary by an economist named Robert Schiller at Yale, who actually went out and looked at the services provided by housing and divided it into the prices of housing and came up with the realization that housing prices were way, way too high in 2004 and 2005. And unfortunately, not enough people were listening at the time.
That's my point.
Absolutely.
Oh, this mistake that houses were safe was very, very widely made.
Well, seeing no further questions, I'd like to, oh, one more. Okay, last question.
Thank you so much. This is actually for you, President Hennessy.
Okay.
You made a tremendous commitment to undergraduate financial aid, which I applaud you on. My question is, on the graduate side, it's a really different story. There are some students that have their tuition paid and get a stipend, while others go into tremendous debt to come here to Stanford. So my question for you is, do you see any changes coming on the graduate side, or is there a vision that you have for the aspects of graduate education at Stanford?
Well, I think let's say in terms of changes, I do expect that we will probably have, looking out at cohorts over the next few years, we will probably have slightly less money available, which will lead to some reduction in the number of graduate fellowships that various departments, where they are dependent on university funding, will have available. That will probably occur. What we've decided to do is protect the existing graduate students that are already here and respond by reducing some of the cohorts in the future, which seems like the reasonable approach to doing that. Obviously, for parts of the university that are dependent on federal funding to fund most of their graduate students, the situation could vary quite a bit depending on what happens after the stimulus package. After all, the difficulty with the stimulus package is you're given a lot of money and told to spend it all in 15 months. That's not a recipe for long-term support for graduate funding. So our concerns are over what will happen. I think, as you heard from a number of our panelists, the budget deficit is growing rapidly. It cannot continue to grow at the rate it's been growing. How that will be resolved in Washington as they wrestle with the health care issue will be a really tough question. And I think you can see lots of beginnings of that. When I was back in Washington, the president had called a meeting of leading senators to the West Wing to try to hammer out exactly what kind of agreements could be structured around this. And I think that will be the key going forward. We will be trying to moderate graduate tuition in the medical school, which I think traditionally in many institutions is the largest creator of debt. Stanford is an absolute leader, with our students graduating with much smaller amounts of debt. But that will be a challenge, I think, as we go forward. As I've said to our alumni as I've traveled around, we are focusing our fundraising on people, people, and people. We're done with buildings. We're not focused. We have a little bit to do on buildings, but we're not focusing on raising money for any new buildings. We're focusing on bringing in endowment to support faculty and students. And we're doing that with expendable funding as well. And that's the way we'll be trying to focus it. Let me bring this meeting to a close then, and please join me all in thanking our panel for their wonderful contributions.